Today, we look if private equity can break the housing market. If you've been trying to buy a home recently and feel like you're not competing against another family, but a faceless, billion-dollar machine, you're not wrong. Private equity firms, led by giants like Blackstone, have been quietly turning the American housing market into a high-stakes casino. The chips on the table aren't poker chips. They're the very homes we live in. The question getting louder every year is, can private equity break America's housing? Or, more to the point, is it already broken? Let's dig in. Private equity firms are masters of financial engineering. They've long been known for buying companies, loading them with debt, and flipping them for a profit. But after the 2008 financial crisis, they saw a golden opportunity. Millions of foreclosed homes sitting empty and cheap. Blackstone and other firms swooped into cities like Atlanta, Phoenix, and Orlando, buying houses by the thousands. At the time, they claimed it was a public service, saying they'd stabilize the market and keep neighborhoods from rotting. In reality, they were building a new business model, the corporate landlord. Today, firms like Blackstone own tens of thousands of homes. While they only control about 4% of the total U.S. housing stock, their presence isn't spread out evenly. In some markets, like Atlanta or parts of Florida, these Wall Street landlords can own 1 in 5 homes on a single block. This concentration gives them serious control over prices. This is where things get both clever and a little unsettling. When you pay rent to a corporate landlord, that money doesn't just sit with the property manager. It gets bundled up with thousands of other rent payments and turned into something called a rental-backed security. Think of it like the mortgage-backed securities that caused the 2008 crash. But instead of homeowners paying mortgages, it's tenants paying rent. Pension funds, universities, and even foreign governments buy pieces of these bonds, collecting steady payouts as tenants pay their bills. So yes, your rent might be helping to fund a teacher's retirement in California, a university endowment at Yale, or a foreign oil fund. The irony is staggering. People priced out of homeownership in their own communities may be unknowingly financing the very landlords who are raising their rent. Rent isn't the only way corporate landlords make money. They are notorious for hitting tenants with extra charges. Pet fees, convenience fees for paying online, and various admin and move-in fees. It's death by 1,000 cuts. But because private equity operates at a massive scale, those tiny fees add up to millions of dollars across thousands of properties. They also benefit from a massive tax loophole. Private equity profits are often taxed at the carried interest rate of 20%, instead of the higher 37% regular income tax rate. This saves the industry billions, and their powerful lobbying arm fights ferociously to keep it that way. Private equity doesn't just rely on scale. They also use technology. Many of these landlords use pricing software like RealPage, which tells them the optimal rent to charge based on data from across the market. It sounds efficient, but lawsuits claim it creates a kind of unspoken collusion. If every major landlord uses the same algorithm, rents can rise in lockstep and competition falls by the wayside. When corporate landlords control a large part of a neighborhood, this algorithmic pricing doesn't just follow the market, it sets it. That's one reason why rents in places like Austin, Atlanta, and Tampa have skyrocketed well beyond what local wages can keep up with. Private equity firms aren't buying homes at random. They are flocking to states like Texas, Florida, Georgia, and the Carolinas. Why? These areas have strong job growth, business-friendly regulations, and most importantly, landlord-friendly laws with fewer protections for tenants. The math is simple. High demand plus weak renter safeguards equals higher, more reliable profits. One of the strangest parts of this story is how much of this game is funded by your money, or at least money close to you. Pension funds for teachers, firefighters, and police officers are huge investors in private equity housing funds. Why? Because rent payments are seen as stable, long-term cash flows, which are perfect for funding retirements. But here's the kicker. In California, pension money from public workers was funneled into funds that helped Blackstone fight against rent control initiatives. Translation: the retirement dollars of teachers were used to oppose policies that might have made their own rents more affordable. Even charitable foundations are getting involved. A San Diego nonprofit sold thousands of affordable housing units to Blackstone to diversify its assets. That decision may have helped the foundation's bottom line, but it also meant thousands of working families were faced with higher rents. None of this happens in a political vacuum. Real estate lobbying groups have doubled their spending in recent years, fighting against tenant protections and regulations. Private equity firms spread campaign donations across both political parties, ensuring their interests are protected no matter who is in office. They also invest heavily in public relations. For example, Blackstone has created slick myth versus fact sheets to argue that their ownership of homes is tiny and harmless. They've even appeared on shows like CNBC in glowing segments, portraying them as a positive force. If their impact is so benign, why spend millions convincing us it is? When rent control comes up, private equity firms close ranks. Advocates say it provides stability and prevents displacement. Critics, however, argue it discourages new construction. Why would developers build more units if they can't raise rents? The evidence is mixed. New York's rent control has created stability for some families, but it's also led to neglected properties and tens of thousands of vacant units. In St. Paul, Minnesota, a strict rent cap caused an 80% drop in new housing construction almost overnight. Most experts agree that the real solution is more housing supply. And here, private equity is both a villain and an occasional helper. Some firms are funding build-to-rent communities, new suburban neighborhoods of single-family homes designed for renters. They do add supply, but they're also designed to maximize profits, often targeting higher-income renters rather than building the affordable starter homes America desperately needs. Let's be clear, private equity didn't create the housing shortage. America has been underbuilding homes for decades, especially entry-level homes. In the 1970s, we built over 400,000 starter homes a year. But private equity has taken that shortage and turned it into a weapon. By buying up homes, using algorithms to hike up rents, adding on endless fees, and lobbying against tenant protections, they've made the problem so much worse. Will it cause a 2008-style crash? Probably not. But can it hollow out the American dream of homeownership for millions? Absolutely. In some markets, that's already happened. Long term, the future of housing is still uncertain. Some analysts predict we could eventually swing from a shortage to a surplus as birth rates fall. Think of the ghost cities in China, where brand new apartment buildings sit empty. Others point to the coming great wealth transfer, with trillions set to be passed from baby boomers to millennials and Gen Z. This could ease the housing crunch for some, but it will deepen inequality for those who won't inherit a dime. Either way, the short-term outlook is tough. Buying is harder, renting is more expensive, and private equity isn't going anywhere. In fact, Blackstone just closed its largest real estate fund ever, $30 billion, ready to buy more homes. So, can private equity break America's housing? If break means turning homes into financial assets traded on global markets, concentrating ownership, and pricing out average families, then yes, it's already happening. But the crisis isn't just about Wall Street. It's about decades of underbuilding, restrictive zoning, and a culture that values housing as much as an investment as it does a shelter. Private equity didn't invent that mindset, they just perfected it. The real danger isn't a sudden collapse. It's the slow erosion of housing as a key part of the American dream. And unless supply catches up or policies shift dramatically, more neighborhoods will wake up to find that Wall Street, not families, owns the block.